Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a forward exchange contract to hedge foreign currency payable commitment. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you would like to follow along with OneNote, and you don't have to follow along with OneNote, but if you have access and want to follow along, you're going to be in this item, which is the 1140C2, and that's in the problem presentations. Closing this back up, we're going to go through the entire information for the problem first, and then we'll go back into it and take pieces of that practice problem as we work through it. So we're going to be looking at a forward exchange contract. We're going to say on 81X1P, that's going to be us, contracts to purchase goods from a Japanese company. So we're a U.S. company. We're going to contract to purchase goods from a Japanese company. Now, these goods have not been purchased at 81, but we have a contract to do so in the future. Then on 10/1/X1, 60 days later from the contract to purchase or have this transaction, the transaction actually takes place. Transaction taking place meaning we're going to get the goods at that point in time or record the goods at that point in time, and we're going to purchase them on account, meaning the accounts payable is going to go on the books at that point in time as well. The contract will be paid in yen, so the accounts payable that we will pay for these goods that we purchase from a Japanese company will be paid in the currency of yen, that being 3 million yen. On 4/1/X2, 100 days after the delivery, payment is to be made. So therefore, we have the contract happening, basically delivery happened at this point. We recorded the contract on account. Then we're going to pay it 180 days after that point in time on 4/1/X2 the following year. Now we have this other thing, the foreign contract or the forward contract happening at the same point in time. It's going to overlap the same time period, meaning on 81X1, P, us, hedges its foreign currency. So we're going to have a hedge here, hedging the foreign currency payment commitment with a forward exchange contract to receive in 240 days, 3 million yen. So in 240 days, we're going to get the 3 million yen from the forward exchange contract. That's going to cover both those basic time periods. One being the 60 days from the point in time that we basically have a contract to engage or make a purchase to the point in time that we make the purchase when we get delivered the goods at that point that we put it on the books on account. And then 180 days from the point in time that we have the goods on account, then we actually pay it with the payment of the accounts payable. That means that this 240-day forward contract will cover both those time frames, both those time periods, the 60 and the 180 days. The future rate for a 240-day forward contract is going to be $0.0073 to 1 yen. Reason for the 240-day forward exchange contract. So why are we entering into this? More specifically, we kind of went over it, but more specifically here, one, for the 60 days for 81X1, when we have basically the contract to purchase something, but have not yet done so, there's nothing that would normally be recorded on our books at that point in time. To 10/1/X1, the forward, and that's the point in time that we actually got the goods. The forward exchange contract is a hedge of an identifiable foreign currency commitment. We have a commitment because we have basically a contract at that point in time. So the forward exchange contract is in essence covering that. And two, for the 180 day period from 10/1/X1 to 4/1/X2, the point in time that we actually got the goods delivered, therefore recorded the goods on our books and on account, and then have a payable on the books, which we're going to pay in foreign currency. That's what's going to be in this time period. The forward exchange contract is to hedge of a foreign currency exposed net liability position. So then we have the spot rates and the forward exchange rates that are applicable to the dates that we are going to need them for. Summary in the timeline, just one more summary on this timeline. 81X1 sign contract for goods and enter into a 240-day forward exchange contract to hedge the foreign currency payable commitment. So those two things happen at the same time, but you can think of them as basically separate things, even though one is done in part because of the other, in part because of a hedge of the other. 81, we have a contract to enter into a contract, into a purchase, but have not yet done it. And we're entering the 240-day hedge at that point in time as well. And then on 10/1/X1, received goods from goods ending firm commitment. So now we get the goods from the Japanese company to us. So that ends that first part of the contract, and that we had to purchase the goods, but now we purchase them on account, so we have a payable on the books. Then we have the exposed foreign currency payable 12/31/X1 balance sheet date. So meaning there's going to be a balance sheet date where we have to make the financial statements in the middle of this thing, and therefore we'll have to readjust our foreign currency accounts at that point in time, like an accrual type transaction. Then on 4/1/X2, we're going to pay the AP in yen with foreign currency units received from the completion of the forward exchange contract. The forward exchange contract is going to result in us receiving the yen that we need in order to pay off the payable that we agreed to pay for the goods that we purchased from the Japanese company. Then we have the hedging on the unrecognized foreign currency firm commitment as a foreign currency fair value hedge, accounting for an unrecognized firm commitment to enter into a foreign currency transaction that is accounted for as a fair value hedge. A firm commitment exists because of the binding agreement for the future transaction that meets all requirements for a firm commitment. So we have basically that binding agreement to have a transaction on 8/1. And then the hedge is against the possible changes in fair value of the firm commitment from the changes in the foreign currency exchange rates. All right, having said all that, now we're going to be on 8/1. We're going to start to record these transactions. So on 8/1, we had the commitment to enter into a contract later, but we have not yet done so. We haven't received basically the goods, which we're going to say is inventory yet at this point in time. Therefore, no financial transaction related to the purchase of inventory because we haven't paid for it, haven't received it, but we've made a commitment, a contract in order to do so in the future. And therefore, we want to put our forward contract on the books now until the end that we expect the actual payment to be paid for the inventory we expect to purchase in the future due to the contract that we have. So we're going to put this on the books. We have the foreign currency receivable and the dollars payable to the exchange broker. In essence, putting on for the forward exchange contract, an asset and a liability will basically go on the books. The asset being basically a receivable, foreign currency receivable from the exchange broker. However, that receivable will be in yen. That's the key point. It's going to be in yen. We're going to get 3 million yen in the future. That 3 million yen, which we're valuing at this point in time in US dollars, which we'll calculate shortly using the forward exchange rate. Then we have the dollars payable to the exchange broker. That's going to be this liability. This is actually in dollars. So we're going to calculate the dollars here. Once we calculate it, it'll be there. It won't change until the end of this contract, until the end of the 240 days. So let's take a look at the calculation. We're going to be saying that we have the 3 million yen, and we're going to be using that, not the spot rate, because we're going to be using the forward rate. So recall that the forward rate is predicting into the future what it will be at the end of this time period, being at April 1st. So we're making our contract always predicting forward until that point in time. And as time passes, here, this is the passing of time that will happen in our problem, and this is the days that will shorten until that point in time, April 1st, when we're there. So these are going to be like the predictive rate. We have the 3 million times the 0.0073. That's going to be the 21,900. So we have the 21,900 debit, the 21,900 credit. We have the accounts receivable on the books at the 21,900, valuing the 3 million yen that we expect to receive in 240 days at the end of this contract in dollars using the current forward exchange rate. Then we have the dollars payable to the exchange broker, which is just on the U.S. currency, will not change throughout the entire problem until we have to pay it at the end of the 240 days. Next transaction we're going to say is on 10/1. You'll note that everything prior to this current transaction we're on, and including the current transaction, will be included in the entries column. So the entries column is going to be all the activity that we have done thus far for the current year that we will be working on. 10/1 then. 10/1, what happens is we actually get the inventory. So the inventory has been received. So we're first going to revalue at that point in time the receivable for the forward contract. So we got this point in time, we're going to revalue the receivable. We're going to say, all right, let's revalue the receivable. It's currently on the books at 22.5. Actually, that's what it's on the books now. Let's go to the prior slide and just see what it was before. We just put it on the books for 21.9. So we put it on the books for 21.9, and we're saying now it's going to be 3 million times, and now we're at 10.1. We're going to use the forward exchange rate. So remember, that's predicting. That's the predictive rate that's going to be predicting till this end point in time. So now we're at 10.1. So it's going to be 3 million times the 0.0075. And that's going to be, I didn't hit the times button or something, 3 million times the 0.0075. That's going to be the 22.5. We have 21.9 in there. So 22.5 minus the 21.9. That's going to be the $600. That $600 is going to result in a gain. Why? Because last time we had 1 yen was worth $0.0073. Now 1 yen is worth $0.0075. The yen has gotten stronger because it's worth more dollars at this point in time. We're talking about a receivable here, which means we're going to get paid in yen, and we're going to get paid in something that has now gotten stronger, resulting in a gain. Also note that you can calculate that gain by saying 0.0075 minus 0.0073 times the 3 million. And that'll give us our 600 as well. So we're going to say we're going to record this thing out. We have the foreign currency receivable up top. That's going to be included in this number. So now we're at the 22,500. We have the gain that's going to be down here on the income statement. We have the 600 on the gain, which will of course affect the net income. We now have in the receivable the 22.5, which you'll recall is 3 million times the current forward rate 0.0075. So there's the 22.5. Next transaction, we're going to be down here and say that we're basically going to revalue this thing now as or put it into our firm commitment item. And what's ultimately going to happen is we're basically going to value what we purchase, in this case the inventory. We're going to put this change in the inventory, this change in the currency, because we had a commitment to purchase the inventory, and this change in the gains and losses, we're going to say is kind of basically we're going to capitalize it as part of the inventory. Inventory is not on the books yet because we haven't got it yet. So what we're going to do is put this kind of in a holding account. I'm going to record it as a liability account because it's going to show as a liability. You can kind of think of it as basically maybe a contra asset account, contra asset to what we're purchasing in some ways, because we're going to be purchasing inventory. If we were purchasing equipment, it would be there, and it could be a debit or credit, just depends on which way the foreign currency is going to go. But the point is, it's going to be a balance sheet account, a permanent type of account, instead of an income statement type of account that's going to hold on to this balance basically until we actually put whatever we're purchasing, in this case inventory, on the books, and then we'll include this amount in the inventory purchase. So what we're going to do is we're going to say, well, we're going to record a loss now. The loss is going to net out the gain, basically removing it from the income statement. Now there's no effect on net income, taking it out of the temporary account. We're going to put it into the firm commitment. Firm commitment, 600 here. I'm going to put it on as a liability, and that's just basically going to be held until we actually purchase the inventory. So next item we're going to say, and remember all of these items, all these transactions we've done thus far, and including the current transaction, are included in the entries column over here. So next we're going to put the inventory on the books. We're going to put the inventory on the books. Now, when we put the inventory on the books on 10/1, we're purchasing it on account. So that means we got the inventory, we received it, we need to put it on the books, but we have not yet paid for it, so we're going to have a payable on the books. However, when we pay for it, we're going to pay for it with yen, so we got to account for that fact. So when we put I'm going to go up here to our data. When we put it on the books, normally we do so using the spot rate, even though we haven't yet paid for it. We're not going to pay for it till April 1st, but typically we put it on the books with the use of the spot rate. So we're going to say, and so we're kind of, and you can kind of think of that as like we're valuing basically the inventory as of this point in time, what it is now, because this is when we got it. Even though we haven't not paid for it, and even though the currency will vary by the time we actually do pay for it, this is where it is at this point in time. So we're going to say we got the 3 million times the spot rate, which represents the exchange rate at this point. So that's times 0.007. So that's going to be the 21. So that's going to be the liability we're going to put on the books, the accounts payable, 21,000. So the 21,000 is there representing the fact that we owe 3 million yen that we're going to pay at a future point. Then we have this firm commitment that we had on the books, and I'll go back up to the prior slide of the $600. That now is going to go off the books. It's on the books as a debit. We're going to take it off the books as it's on the books as a credit. We're going to take it off as a debit. And then the difference is going to be the inventory. So you can see what happened with inventory then. We basically put it on the books like we normally would for the purchase price using the current spot rate, exchange rate at that point in time, and then capitalized the change in the foreign currency into the price of the inventory, putting it and including it in the cost of the inventory. So the inventory then on the books at the 20,400, the plug, the 21,000 minus the 600. If we then record this out, then the inventory goes on the books at the 20,400. The firm commitment then goes back down to zero. It now at zero. And then the accounts payable, here is going to be on the books at the 21,000, but it's in yen. So it represents basically the 3 million yen that we're going to have to pay, translated into dollars using the current exchange rate, the spot rate. Okay, next transaction. We're going to say now it's 12/31, so it's the balance sheet date. So we got to adjust our entries for the balance sheet time for any accruals necessary for the foreign exchange valuation. So all the prior transactions and including the current transaction we are working on are included in the entries column here. We're going to be doing this adjustment for the end of the year for our balance sheet. Same kind of process with the accounts receivable. But let's first go back up to the prior slide to see where the accounts receivable was before. Then we're going to make the change as of 12/31. So I'm going to go back up here and we're going to say, all right, here's the accounts receivable. This is what we're going to receive in yen later, which we valued last time at 22,500. Now it's December 31st. Let's value it as of this point in time, which means we're going to take the 3 million times the forward rate, because we're looking at the forward contract at December 31st, which is 0.0077. So 0.0077, that's going to be the 23,100. And we currently have 22,500 in there, so minus the 22,500, that's going to give us a $600 difference. So another $600 difference we're going to have here. This time that $600 difference will be a gain. Why is it a gain? Because last time we had 1 yen was worth $0.0075. Now 1 yen is worth $0.0077. The yen has gotten stronger, and we're talking about a receivable here, meaning we're going to get paid in yen. So that's going to be a benefit to us and therefore a gain. Also note we could calculate that $600 by saying the difference between the rates, 0.0077 minus 0.00775 times 3 million will give us that same $600 difference. We're then going to say the foreign currency receivable is going to be the debit of the $600 and the foreign currency transaction gain will be the credit. So the receivable now is at that 23,100. The gain now is included in this 1,200, affecting the net income. Once again, that 23,100, if we were to calculate that, would be the 3 million times the forward rate as of December 31st, 0.0077. So there's the 23,100. Next item we're going to have as of the end of the time period, as of our balance sheet date, and recalling that all the transactions up until now are here, current transaction here, all those including in current transaction are included in the entries column. We now have the payable on the books as well. We're going to have to make this payment at the end of the contract. We're going to be paying it in yen, which we valued last time. Let's go see what the value was last time in the prior slide and then adjust it to the current time period. So we left off last time with it at 21,000. It's now December, and so we're going to pick up the current rate at this point in time. So let's do that. I'm going to scroll down to do that this time. I'm going to say let's go down to here and pick it up. So we're going to pick up the 3 million times. This time we're using the spot rate because we're adjusting the accounts payable, which we're just going to adjust to the current exchange rate at this point in time, which is the 0.008. And that's going to be the 24. So we have in it right now 21,000 before we make the adjustment minus the 24,000. That means the adjustment, hold on just a second here. It was 24,000 that we calculated minus 21,000. That's going to be a difference of $3,000. So there's a $3,000 difference. That difference is going to be a loss. Why is it a loss? We expect it to be a loss to be offsetting this one. So that would be one reason we could say, that kind of makes sense, even though it's not the same amount because we're using forward rates and spot rates, but it should be, going opposite directions. And we can take a look down here. We could say, well, last time it was 1 yen's worth $0.007. Now 1 yen's worth $0.008. The yen therefore has gotten stronger. It's worth more dollars. And this time we're talking about a liability here. We're going to get paid in yen. So the fact that the yen has gotten stronger is going to be bad for us in this case because we're going to be paying in something that has now gotten stronger. Therefore, it's a loss. So we're going to say, let's record that then. We're going to say the foreign currency transaction loss will be the debit. The accounts payable will be the credit. The loss will be included down here on the income statement. Then the accounts payable is going to be included here at the $24,000. So now we're up to that $24,000 once again calculated as the 3 million times the current spot rate, 0.008. We can also calculate that difference, that 3,000, by taking the difference in the rates, 0.008 minus 0.007 times 3 million. Not 30, but 3. And there's our 3,000 once again. Next transaction, we're going to move on to the next year now, year 2, because this is going to the final point we've all been waiting for, that being April 1st. That's when the accounts payable is going to be due and when the forward contract ends. So a lot of activity that we can look forward to here. We're going to say then that we're going to take the prior slide's ending balances as of the end of year 1 activity, those then being the beginning balances we will have in the year 2 activity, except for, of course, the income statement accounts have now been closed out into what we're going to call the equity account, which just includes the retained earnings here. So down here, we're starting off with a basically post-closing trial balance for year 1 or beginning balance for year 2. Nothing in the income statement or temporary accounts until we move forward from this point. All right, so now it's going to be 4-1. We're going to have to do the same process. We're going to have to revalue our foreign currency accounts once again. So we're going to be revaluing the receivable and the payable. Let's look at the prior slide first. We're going to do the receivable first. Let's see where we left off last time. Or we could just pick it up right here because this is the beginning balances here. So last time we had it at the 23,100 and now it's 4-1 at this point in time. So now we're going to be down here. So we're going to take our 3 million again and value it to the current date. And time is flying now here because now we're at the end of this thing. And there is no forward exchange rate. Why? Because this forward exchange rate has always been aiming at this end point when the contract will end. And that's going to be on 4-1. We're at that point. It's in the present now. Therefore, there's no forward rate. All we have is the spot rate. So we're going to take that 3 million times the spot rate, 0.0076. That's going to be our 22.8. 22.8 minus what's currently in there, 23,100 before we do our transaction. That's going to be a $300 difference. $300 difference is going to be a loss. Why is it going to be a loss? Last time we had 1 yen was worth $0.0077. This time 1 yen is worth $0.0076. Yen is worth less dollars. Yen has gotten weaker. This is a receivable which we're going to get paid in yen, and the yen are now worth less than they were before. Therefore, we have a loss. So we're going to be debiting the loss. We're going to be crediting then the foreign currency receivable. So if we see that posted out there, the loss is going to be on down below in the income statement. The receivable is going to be up top in the receivable. The receivable now at that 22,008, 22.8, once again calculated as 3 million times 0.0076. We'll see that 22.8 multiple times now. So then we're going to go down and say, then we're going to do the same thing for the payable, the accounts payable. Same kind of activity here. This is the accounts payable where it was at before. Now we're going to revalue it to where we're at now, which is 41x2, which is the end of the time period when we actually have to pay the accounts payable. So we're going to do the same kind of process here. We're actually going to use the same calculation this time because we didn't use a forward rate last time. We're using the spot rate because, again, this is where everything converges at the end. It should all be like, tying out. So now we've got the 3 million. This is like the climax here. So times the 0.0076. That's going to be the 22.8. Once again, what's currently in there, the 24,000. So minus the 24,000. we're going to have an adjustment of 1,200. 1,200 adjustments going to result in a gain. Why? Well, one, it's the opposite of what we did last time with the receivable. That's what we would expect, even though it's not the same number exactly. And if we think about it, we're going to say, well, last time we had 1 yen was worth $0.008. Now 1 yen is worth $0.0076. The yen has gotten weaker. And this time we're talking about something that we're going to be paying. We're going to be paying in yen, paying in something that's less valuable than it was before. Therefore, that's good for us. We're going to have a gain. So we're going to debit the accounts payable for the 1,200. We're going to be crediting the gain for 1,200. If we record that, then the accounts payable is now at that 22,800. The gain is included down here, down below on the income statement, and therefore included in the net income. This 22.8, once again, calculate as 3 million times 0.0076, the spot rate on April 1st. There is our 22.8. That represents what we owe right now, today, meaning 3 million yen, which is currently valued at $22,800. Okay, next transaction we're going to have, and remember that everything up until this point in time for year 2, and including the current journal entry that we are working on, this one, will be included in the entries column here. So now we're going to say that we're going to pay off part of the forward contract. To see it, let's go back up to the prior transaction to see what's on the books now, and then we'll see the transaction related to it. The forward contract now has this $21,900 payable on it, and we're going to go ahead and pay that component off because now we're at the payment period on April 1st, which was 240 days after the forward contract was made. Now, just remember that no change has happened here on this item, meaning when we put the forward contract on the books, we put 3 million times the forward rate at 8.1. When we put it on the books, 0.0073, and we put it on the books at that 21,900. And then we didn't touch it because this is going to be in cash. So we didn't have to adjust it for the foreign currency. We didn't have to do anything. We just said, hey, we're going to pay that off at the end of this contract period, and we're going to pay it off in dollars. So there's a payable. It's due now. It's payable in dollars. Nothing funny happening. So we're going to go down here, straightforward transaction. From a transaction perspective, we're going to be paying the dollars, crediting the dollars. We're going to be debiting the dollars payable to the exchange broker, the payable account, and recording that out. That will decrease the dollars up top, and that will be taking down this part of the forward contract, it now being paid off, it now going down to zero. Next transaction is going to be the second part of the forward contract. Remember that all transactions are up top, and then this is the one we are working on. All of them are included in the entries column here. Okay, so before we do this one, let's go back up top and think about where we are at before that transaction again. We're going to say that now we're going to do the other side, right, of the forward contract, which is this foreign currency receivable from the exchange broker. So they owe us $22,800 worth of yen, meaning 3 million yen, because that's what we expect to get paid in, that we currently valued using the current spot rate at $22,800. So we're going to get 3 million yen, currently valued at $22,800. We're going to remove the receivable of the $22,800 that we're going to get the yen from the broker, and then we're going to put it on the books, not at 3 million yen, but at the $22,800, the current exchange value of the 3 million yen. So if we do that, then we're going to be debiting the foreign currency in units. So remember, you see currency here, so you might think like this is cash, and it is kind of cash, but it's not our cash. It's not what we measure our books in. So to us, it's basically like an investment. It's just like a stocks or something that we're valuing those units in terms of dollars. So we're going to be debiting the foreign currency units, and then of course we could have a sub-ledger, right, that would be telling us this is 3 million yen that we have here. And then we're going to be crediting the foreign currency receivable from the exchange broker. And once we record that, that means the receivable is going to be going back down to zero, and then we're going to be putting the foreign currency yen on the books at that 22,800. Okay, so now we've got the foreign currency units, which we valued at $22,800, but which are really 3 million yen, and we've got the payable on the books that we owe to the Japanese company for the inventory we purchased, represented as $22,800, which really represents the format that we're going to pay that in, which we promised to pay in, which is 3 million yen. So we can go ahead and pay off that 3 million yen and record the cash dollar equivalents on our books, taking those items off. And that's, of course, what we will do next. So next time, we're going to remove the payable, debiting the payable at the 22,800, crediting the foreign currency at the 22,800. When we record that out, the payable then goes back down to 0. The foreign currency units then go back down to 0. Where are we at the end of the day? We got the cash on the books now. We got the foreign currency units are now gone because we got them from the forward exchange contract, but then we used them to pay off the payable, which is the reason we had the forward exchange contract on the books in the first place. Then the foreign currency receivable from the exchange broker has now been going back down to 0 because they gave us the foreign currency at the end of the time period, which we then put here, but then we used it to pay off the accounts payable for the inventory we purchased. Then we have the inventory that's on the books. Now notice it's on the books for not simply the 20,000, which was the point in time that we received the inventory, right? Because we got the inventory at 3 million times when we got it. You would think we would use the spot rate 0.007, the 21,000. But we capitalized basically part of the gains and losses in the foreign exchange currency from the point in time we had the contract, but not yet the inventory on 8/1 to 10/1. And so that was included. We basically put that in the firm commitment and then included that in the inventory. Then all other foreign currency transaction gains and losses that happen from that point forward, whether they be from the forward contract or from the accounts payable change in value, were then recorded on the income statement, and then prior year rolled into the equity section, and then this is the current year information there. So that's one of the key points and differences in this problem than some other kind of formats. If the contract, for example, this contract had not been a contract but simply an agreement, something we expect to happen but don't have a formal contract for, or if we didn't have anything there, right? So then we have the accounts payable then has now been paid off. We paid it off in yen. We have the dollars payable to the exchange broker, which has now been paid off. We paid those off in dollars. We have the firm commitment that now has been paid off. We use this firm commitment as a holding account to hold the change in the value of the currency before we put the inventory on the books so that we can include it on the books. So this is a permanent account rather than a temporary account that helped us to hold on to that change in value so that we can then include it in the thing we purchased, which in this case was inventory. Then we have the retained earnings, which has changed from 100,000 due to the equity changes in the income statement in the prior year. Then we have the current year income statement effects from these transactions in the foreign currency gains and losses.